This week's Hopkins Group's Mark Wenzel joins us as he does every week to look at the markets. Mark, welcome.
Thank you, Ben. Good to see you.
Thank you. You too. So the RBA, we didn't get much relief for very long. They've stuck interest rates up again on us.
Yeah, absolutely. So they raised by 1/4 point on Tuesday, which which I think generally the broad economy and the economists within there sort of didn't expect any rate rises. They expected the pause to remain longer, but obviously with a 7% inflation rate, while lower than the previous inflation rate, it's still well above the 2 to 3% target range that the RBA has. So so they obviously felt that they needed to raise interest rates, and I think the key driver of that inflation really was the services inflation. So during the COVID period, the price of goods went up a lot, due to supply chains and obviously people buying goods at home. But it's really now the services where people are going out to restaurants and eating and going to shows and going to travel, which is really pushing the prices up of goods across the economy.
Where does it go? Where does it end? Like, I mean, you're the expert. I mean, inflation 7%, as you say. The RBA want it around 2 or 3%, which is ideal. We've seen overnight in the US, put interest rates up again with the Fed. But it seems to me the key metrics of economics aren't really the same as they were, say, in the 90s or the 2000s. So how does it really do it? Like, from an economic point of view, yes, inflation's too high, but the pressure it's putting on low and middle income families is extraordinary. Where do we go?
Yeah, look, it's a fascinating one, no question. I mean, the service inflation really is driven by wages, and again we're seeing wage claims, and we're seeing obviously the university lecturers going on strike, and we're seeing wage pressure, and so the reality is I think it's really going to be difficult for the RBA to get anywhere near the 2 to 3% range without obviously sort of some more government intervention, potentially in terms of getting more immigrants in to reduce or increase the supply of labour, but also probably to reduce their expenditure, which is again really inflationary. They're spending a lot on infrastructure, which is causing demand for labourers and carpenters and builders and bricklayers and those sort of things, which is affecting other areas of the economy. So I think the RBA is doing all of the heavy lifting at the moment, but we really need a concerted effort from the government to reduce their expenditure, perhaps bring their state and federal, bring their budgets back into balance, which again will cause economic pain, and obviously that's part of the side effect, I guess, is that there is going to be economic pain in sectors of the economy, but that's really going to help drive that inflation down.
How do we help small business? Like, I mean, I come from a hospitality point of view, for a long time in hospitality, and then start talking about various things. But from a hospitality point of view, businesses have over COVID, the ones that stayed or tried to stay functioning, accumulated more debt, really not their own fault. And then the ones that sort of wanted it to go back to 2019 desperately, which it's not going to, unfortunately, are still trying that old model. We're not going to change anything. We're just going to keep going. But as they keep going, they've still got this mounting debt. They got ATO debt. They got payroll tax debt they're not being able to do. What's the answer for small business? Or are we just going to see more small businesses fold, sadly?
Yeah, I mean, I think, as I say, it's definitely going to be a side effect, unfortunately. But I mean, again, I guess governments play a role in that area as well, don't they? So, again, obviously, payroll taxes and other taxes that they've put on. But again, they're at an issue as well, because they've obviously got massive debts to pay off. So it is absolutely problematic. But I mean, I think within the hospitality area as well, I mean, it is getting some more students back in. So again, we get more workers, perhaps, that keeps that cap on wages, so the profitability of hospitality businesses is maintained, and potentially, I mean, more price rises probably as well, in order for them to get a decent return on their investment and their time that they spend within the business, and again, that's problematic for inflation. But yeah, I mean, I think there's no simple sort of answers to any of that, but it's probably a combination of government you know, as I say, increasing labour and also obviously, you know, businesses making sure that they're getting a return on their investment and their capital.
When you say government government intervention in terms of pulling back on those big infrastructure spends that, you know, like in Victoria, we've got, you know, I'm not even going to start with all that, but, you know, we've got, yeah, let's not go there.
We've got lots.
Yeah, they're doing stuff. But anyway, you know, is it a case of being, you know, just pulling back on that, or, you know, pushing, you know, like the big one is the rail line out to Tullamarine, you know, is it just we're going to delay that, we cut back, all those sorts of things? We probably see in the state and federal budgets coming up.
Yeah, I think that's definitely part of it. I mean, again, you know, there's a limited supply of labourers, and if they're all working for the government because they're getting well paid and looked after and penalties and all those sort of things, I mean, it doesn't leave a lot of room for home builders to get the labour and the staff that they need to build houses for people as well. I mean, you know, again, that's a massive issue, I think, for the broader economy. So yeah, governments, you know, reducing that expenditure, you know, they're borrowing money to pump into the economy. That's inflationary. So if they can pull some of that money back, that'll sort of reduce some of the pressure on inflation. It'll also allow labourers and workers to move into non-government areas, which will again improve supply lines, improve demand supply. You know, again, for the hospitality workers, it'll mean that there's more more workers available for them. So it's all of those things, and that's, you know, again, the challenge at the moment, because you know, obviously these governments are trying to get re-elected and populist and all of those sort of things, and if they're pulling back, it makes it more difficult for them to do that. But again, from my point of view, it's important for the economy. You want them to be stepping into the economy when things are going bad. You know, when we need support, when you know, unemployment rates are 6 and 7, 8%, not when it's 4% or 3.6, which is currently at the moment. They're sucking, you know, labour out of the economy at a time when there's not a lot of labour available, and that's not the right option for governments, in my point of view.
Yeah, and I mean, you know, and then the other side of it is NAB have come out today and they, you know, we've made $4 billion profit in the last 6 months. And I mean, I think, you know, I'm not an economist, and, you know, that's why I talk to you, you know, but it's a case of the average punter that's seen, and I mean, my wife and I have seen it, you know, our mortgage has doubled in the last 12 months. And, you know, we were lucky that we bought when it was high and could afford it, and, you know, all these sorts of things. So we were lucky, but it's still a struggle. But then you see the NAB go, that's another 4 billion in the tank. Thanks very much. I mean, the average punter's just going, what? You know, it's just the inequality of it seems out of whack at the moment.
Yeah, it sounds like a massive number, and it is to most people. But again, I mean, they're really big organisations, multi-billion-dollar organisations, hundreds of billions of dollars, you know, in terms of their valuation, and they need to get a return on their investment, and they obviously make big investments into, you know, branches, even though they're closing, and, you know, obviously making sure that technology systems in place so they can do lines. So I mean, it's not an unreasonable profit, but it sounds bad, but it's not an unreasonable profit. And most people will own NAB shares, whether it's through their superannuation fund or other investments that they do have. So they will get some benefit back for that. And, you know, I suppose it's been a really good environment for the banks, because when they're raising interest rates, they can, you know, raise interest rates for borrowers very quickly, and then they're slow in passing the interest rate differential onto, you know, people that are, you know, bank deposits and term deposits and those sort of things. So they get a bit more of a margin increase, you know, with that. But I mean, I think it's wrong, you know, probably to focus on, you know, the size of the profit. You know, it's important that that businesses operate profitably, even obviously, even though it's impacting, you know, the people in the street, and they're obviously hurting. But it's important for businesses to run profitably, you know, just so that there's jobs and there's you know, the economy's strong, and that the banks are strong within the economy.
And we're much, I suppose, and absolutely, you know, I understand totally, you know, and I suppose we're a lot better off here than they are in the US, where they have, you know, we've seen several private banks, or I assume they're called private banks, you know, go under because they just don't have any, you know, they don't have any money in the bank.
Yeah. Absolutely, and we've operated really differently. Again, absolute credit to our regulator APRA who manage the banks. They made them increase the rigor around the borrowings to make sure that people could afford to repay if there was significant interest rate rises. They've increased the capital required for banks in order to maintain stability and get access to the cheap money that they have got. So they've put really good regulations in place to make sure that our banks are strong, which is terrific. But as you say, in the US, there was another bank overnight which is sort of brought into question. And so the issues that they have over there is that they've borrowed long-term at 2% because they fixed their rates in the US for 30 years rather than shorter terms. And so they've lent the money out at 2%, but they're borrowing at now what's 5, 6, 7%. And so they've got a massive mismatch in terms of assets and liabilities that they have on their balance sheets, which is causing great stress in the US banking system. And, that's the last thing you need in an economy is to have those concerns.
Do you think they'll go into? I mean, Jerome Powell said they won't, but do you think they'll go into recession?
Look, I mean, again, it's difficult. I mean, I think the interest rate rises, whether it's here or in the US, are designed to put pressure on businesses and to encourage them to cut spending and all of those things. I mean, that's what the aim of the interest rate rises are. So, I mean, I think it's going to be difficult for them not to go into recession. And again, I think here it's going to growth is forecast to be 1.7%, which is well below historical averages. So, I mean, I think here again with our employment, strong employment, and all of those sort of things, we should stay in pretty good shape. But yeah, I mean, I think that there's a real chance that they'll have a mild recession in the US, no question.
Yeah, and I mean it's just that where do we how long is it going to take really? We've got 7% now. We want it to be 2 and 3%. We've seen the RBA change it. It's happened again in the US, obviously. I mean, how long? I mean, I suppose that's sort of to you. It's sort of like how long's a piece of string, but we need to going back to what you said about housing. We've got houses near us, that are, people doing builds with Porter Davis, and they're just, finished. And the money they lost was just tragic. But how long is it going to take? Is it 3 years, 5 years? Are we going to spend, the 2020s in this state?
Yeah, it's fascinating, isn't it? Because really, during COVID again, and I think that COVID's been distorting things so dramatically. There was so much money pumped into the economy during COVID. We were all locked down. We couldn't spend and all of those sort of things. So we saved money. So both in the US and in Australia, the savings rate increased significantly. And, in terms of our people, save money into offsets in their mortgages. So they've got lots of buffer. They've got lots of, and so they're not necessarily too impacted at the moment by it. So I think that's going to make the cycle longer in terms of how long it takes for both the inflation to come down, but also the pain to be really felt within the economy because we've built up those buffers. So it is going to take a couple of years, I think, for it to flow through the system. And so, again, it's been sort of 12 months, I guess. So maybe another 12 months and you'll start to see, obviously people having to sell or make serious adjustments to their lifestyle in order to be able to make those repayments. And it could be at that time that rates are significantly higher because the Reserve are going to keep raising rates until that pain is really felt within the economy so that the unemployment increases and that inflation comes down.
Do you think it'll take longer? Like I mean, I come from the generation where my parents saw 17% interest rates. And, do you think COVID is going to make sure that it does take longer? Like as you said before, you've got people, that discretionary spending, travel and restaurants and this and that because they haven't gone out for 2 years or 2.5 years or whatever it was. Is it going to take longer for it to filter through because people have had those buffers, do you think?
Yeah, look, no question, but and also, I mean, again, employment rates are strong. Like everyone's got jobs as well. So again, typically, in Australia, 3.6%. I mean, it always used to be that full employment was 5%. So we're well under that. So so there's no sort of pain, and so it is going to take longer for that cycle to eventuate. But I mean, it will happen, and as I say, perhaps the RBA increases rates further. I mean, I certainly don't think they're going to get anywhere near 17. But you know, even if it's 6 or 7 in terms of what your interest rate is, you know, with the size of the mortgages people have in order to having got into the housing market, because obviously prices rose so significantly, I mean, it is going to start to have an effect, you know, at some stage, and you'll see that in pockets, and you'll see that obviously with the people that bought most recently, probably, and then it'll start to increase to those people, you know, I guess from how long they've owned the house for, how long they've had the mortgage for, you know, how much equity they've got, how much, you know, they've paid off. So it'll start to impact over time, but it will impact because it just does. It you know, does.
And what's your client base, you know, doing at the moment with money? Are they trying to protect themselves against, you know, further inflation? Are they, you know, moving things around, or what are they doing? Or what are you advising people to do?
Yeah, so I'm having lots of conversations around sort of that budgeting and where we can cut some expenditure out in order to make sure that they've got the firepower in order to make the repayments, and particularly if things increase. And we've had obviously clients that had fixed rates that are rolling off, which was the other factor that's probably delaying the pain, in that, you know, over the next 6 months, about, you know, 50% of fixed rate mortgages are rolling off. So there's going to be a significant change there, moving from fixed to variable. So it's those conversations. And in terms of investments, I mean, you know, obviously we're a little bit cautious about the market, but again, I mean, there is lots of positives. You know, there's full employment, you know, particularly in Australia, there's full employment. We've got demand for our resources. We've got demand for our agricultural you know, products. So there is a positive story there behind the scenes as well, rather than just focusing on the negatives. But certainly from an individual personal perspective, people are wanting advice on how to cut costs, you know, in terms of their expenditures. You know, there's you know, considerations around, you know, what changes we need to make to lifestyle, and some of that is, you know, perhaps not eating out as much or eating at home more, that type of thing. So it's really you know, on an individual case by case basis, but there is those discussions because it is starting to impact people, and again, you know, what also people get worried as well, and perhaps they don't want to spend as much because they are worried about what's going to happen in the future, and they want to make sure that they can keep their homes or their investment properties, because again, you know, lack of supply of properties makes it really difficult for people just to sell up and, you know, rent or do something else, because there's no supply, and, you know, what else are they going to do?
Yeah, no, look, I mean, and I suppose it's bad, but it's not all bad, and it will eventually get better. Is really the thing. You know, it's COVID has probably elongated it more than we would want, but you know, there is I suppose a light at the end of the tunnel.
There's definitely a light at the end of the tunnel, which doesn't get talked about enough. And, you know, it is about being able to hold through this period, and you know, rates will come down, we'll get more immigrants in, whatever, and you know, the wages will come down, inflation will come down. You know, over time, it's just about being able to move through this period. And then again, you know, as I say, Australia's in a really good position. We've got demand for people coming in. We're talking about 600,000 people coming into the country. You know,
yeah,
everyone's got a job, even if it moves from 3.6% to 5%. I mean, it's not massively detrimental to anybody, except if you're sort of one of the 1.4%, I guess. But, you know, so there is lots of positive stories there as well.
Yeah. Mark, thanks very much for your time. Really appreciate it.
Great to speak to you, Ben. Thank you.